Now we're going to look at some of the other yen-based cross rates that are interesting. And the first one we're looking at is the Canadian dollar against the yen. And this is just a daily chart plotting the fall through last year and the low that was made in January. And for classical technical analysts, this could be called or referred to as what's called a saucer bottom. So it has a shape of a saucer. And a key thing that really happened this week was if I connect the trend lines through that saucer pattern, taking those two highs, then we can see on Monday we broke out of that pattern on a conclusive basis. Another thing of interest when looking at crowd following is I've just put a 55-day high on this chart, which is what this blue line is here, and this is what's referred to by Donchian traders or turtle-based traders, and they'd be interested in price making a closing 55-bar high. So if we can break the high from yesterday, then we could also get some breakout people getting involved in this market. Whilst it's useful to know what other market participants may be doing, as you know, I'm far more interested in what the supports and resistances were of the previous trend and how the current trend is performing. And the first thing we need to do is look at that previous trend, which dates back to the summer of last year. The thing that really stands out in a similar vein to the dollar Swiss and the dollar yen from a few weeks ago is how bottom heavy the distribution is. So what I mean by that is the most amount of time is right at the lows of the trend. And what this means is that if price can start trading into a higher distribution or start trading into vacuum areas, there's the opportunity for not only new longs to get involved but also major short covering. We already know that there's a very large long position in the yen against a variety of currencies. This is the current trend going from mid-January, and so far we've just popped above what could be regarded as a mini distribution high at this point. Where we're really interested in is if we can start getting above 87.60, because then what that would do was open up a very, very big vacuum that it would extend all the way up to the low 96s. I'm now just looking at the current uptrend, and while it's quite useful to see where the control point is and where the breakout points are, I'm going to show you some of the history of this trend to highlight some key timing points that would have allowed you to think about getting long this contract. I've now gone back to the 20th of January and we're looking at where we were on the 13th of February. And what we have here is a control point that is largely in the middle of the trend, and the reason I know that is because the midpoint, which is this blue arrow, is very close to that. And what this tells me is that the trend is balanced. We're not really trending upwards. All we're really doing is we've moved up and we have the high point of the bell curve coinciding with the midpoint. So what this tells me is now price has to make new closing highs above the high to actually indicate that the trend is starting once again. I've now moved forward to mid-March, and we did make new highs for the trend and attempted to distribute higher, but then we fell back. And I'm just going to merge these 2 days here to show you what can happen as a timing point associated with it. And what we have, if I am to then merge the 20th into the distribution, is suddenly control moves higher from where it was previously. And what this means is that ideally this is a timing point. Shifts in control are times when the new trend can accelerate, or if we were top heavy, or if we were overbought, the market could then reverse. We weren't overbought, and so this gave the opportunity for the market to trend, which is exactly what it did on Monday. If I then just put these last 2 days together, effectively what is happening is we're trying to build a higher distribution, and we have a very, very clear support point, which is at around 78.36 to 24. If we are building a new higher distribution, it really has to try and avoid trading into this area here. If I'm looking for exact timing points, what I can then do is connect this with range deviation pivots, and here we have them on the half-day chart, and it's giving me the values that are going to appear in the first half of today's trading. And I have the second pivot down at 78.22, which is very close to that major support point. So this is telling me that this should be the limit of range, if we're really still in an uptrend on a very short-term basis, I certainly don't want it trading below 77.76. The confluence of timing is very, very important, and here I've got a 480-minute chart with those pivots put in, and this tells me that the limit of range in the third deviation down is at 78.28. So in the very short term, I can look to put in orders between really 78.40 and 78.20 to get a timing point associated with that major support on market profile. Next, we're going to look at the pound against the yen, and this is also on a daily chart. Similar picture, the only real difference is the depth of the spike bottom that we had in mid-January. And I've also drawn this trend line going across those highs to here, and we had a breakout in a similar fashion. I've now zoomed in via candlesticks, and there's really two things that stand out for me in the most recent past. The first is on this correction down. We hit the third range deviation pivot on the day, which is the limit of range on a normalized day, and we reversed very, very strongly and closed near the highs of the day. The second thing that stands out is yesterday's price action, where we made new highs, we made new 55-day highs, and we went up and touched the limit of range for that trading day and then came back down again, but it was still a positive candle. So far today, we've simply come back to the first range deviation down at 42.40. And so if the trend is really a good breakout and it's something that's going to be sustained, ideally on a daily basis, I don't want price to close below this level. If I then look at the profile, again we have a very similar setup, and we have the current lows that are connecting with one range deviation down, and ideally we want price to hold in this area and protect the ability to start building a new higher distribution. I certainly don't want it trading down below 40.76 in this area here if I was looking at it purely from a profile perspective. In terms of saying that the uptrend is no longer an uptrend, we're going to have to go below control here. I've now gone back through the history. I'm just going to show you how the dynamic can be different when points of control change. And here's an example where it moved in the exact opposite way to what the Canada yen does. On this day here, control shifts to the top of the trend, but there is no upward momentum and the price rotates back down again. This is now the day of that major reversal where we hit 3 down, and while we did rally quite strongly afterwards, the control point and the little ledge above control has consistently capped price. Then suddenly 2 days ago, having stayed at control for a number of days, suddenly control acts as support and we start extending higher. When we're looking for places where an uptrend may stall, we have the distribution high up at around 148.80, and then we have a mini vacuum until we begin another distribution. We have a pretty key level around the 150 to 51.60 point. We have to actually start trading above 164 to 166 before we start entering part of the huge vacuum that then targets 182 all the way up to 184.